Hello students, welcome to my class. This is Professor Vincent Osaya, and this is the presentation of part 1 of chapter 5, Merchandising Operations. Merchandising Operations. In chapter 1, recall, we talked about the overview of accounting and the business environment in which accounting operates in. In conclusion, we prepared a set of financial statements which consist of valuable information that is used for different business decisions. We established the fact from the get-go that the most important thing that we do is producing or creating financial statements, generating information for different constituencies. In chapter 2, we talked in details about how to record transactions or how to account for transactions. The same thing, account for or record business transactions. And we also talked about a lot of accounting principles. Those are the accounting rules and how to apply them. Ultimately, again, at the end of chapter 2, we prepared a set of financial statements. In chapter 3, we zero in on the adjusting process, and we said that adjusting process is one of the steps that we have to perform to prepare financial statements. So chapter 3 was very involved. We talked about additional accounting principles and concepts that are applied or followed for the purpose of preparing financial statements. Then in chapter 4, we talked about completing the accounting cycle. Recall, we said that the accounting cycle is the process for preparing the financial statement, or the accounting cycle consists of different steps that we follow to prepare financial statements. So in chapters 1 through 4, we learn a lot of accounting principles or accounting standards, or we also call them accounting rules, how to apply them in order to prepare financial statements. So at the end of every chapter, we prepared a set of financial statements, chapters 1 through 4. So chapter 4 concluded the process of completing financial statements. Now in chapter 5, we are repeating everything that we did in chapters 1 through 4. The only difference is we are talking about everything we discussed in those chapters from the standpoint of a merchandising operation. What does that mean? So because recall, in chapters 1 through 4, we talk about accounting principles, how to prepare financial statement from the standpoint of a service type of company. What does that mean? A service company is a company that provides services for generating income. In other words, service is the main thing that they do, or the main activity that they engage in to produce income. An example would be an accounting firm, a law firm, so on and so forth. But now, in chapter 5, we are going to talk about the accounting principle, the whole 9 years again. However, we are going to be looking at it from the standpoint of a merchandising operation. Why is that? Because a merchandise operation has some peculiar or unique issues that are not applicable to a service type of company. So that being said, let's take a look at the objectives. Here we have objective number 1. We are going to describe merchandising operations and the 2 types of inventory systems. Objective 2, 3. So we have 7 objectives altogether in this chapter. Moving along, let's take a look at the first objective. We are to describe the merchandising operations and the 2 types of merchandise inventory systems. So 2 issues there. Merchandising operations and 2 types of inventory systems. Question: what are merchandising operations? The first thing we need to do is, what is a merchandise company? We said that a merchandise company is a company that buys finished product from another party and turn around and sell those finished products to the customers. A clear example would be Walmart or JCPenney. Do we still have JCPenney in existence? Yeah, JCPenney. So those are some examples of a merchandise company. So they buy finished product, they turn around and sell the finished product to customers. Now, listen to this very carefully. The items or the product that they buy, we call those merchandise inventory. Another name for it is inventory. Some people just say inventory, or some people say merchandising inventory. Now, I want you to catch this. If you go to Walmart, the question is everything that you see in Walmart merchandise inventory? Some students will say yes. Not quite. 99%. Why 99%? Because the computer that the cashiers use, or the cashiers, the computer that they use, the equipment that they use, those are not for sales. The furniture that they use in the customer service department, those items are not for sale. So those are not merchandise inventory. So merchandise inventory are the items specifically bought for the purpose of selling to customers. Moving along, a wholesaler. We said that a wholesaler is a company that buys in bulk. The company buys in bulk and sells to retailers. And retailers turn around and sell to the final customers or consumers. And the retailer can buy either from wholesaler or manufacturer. So we have another word there, manufacturer. A manufacturing company is a company that buys raw materials, process the raw materials, and into finished goods. An example would be General Motors. It's a manufacturer. Moving along, let's take a look at additional issues relative to a merchandise business. The operating cycle of a merchandise company. What does that mean? Recall, in the previous chapter, we talked about operating cycle. We said an operating cycle is the time that it takes a company to expend or spend cash during the normal course of doing its business and get the cash back. In other words, if you're in the business for selling clothes, how long does it take you to travel to China or Europe, buy those clothes, bring them to the south side, put them on the shelf, look for customers? Some customers will buy on credit, you chase them around to pay you, eventually they pay you. How long does it take you to spend cash and get your cash back during the normal course of doing your business? That period of time is called operating cycle. So here we are talking about the operating cycle of a merchandise business. Normally the operating cycle of a merchandise business will be, or a company will be longer than that of a service type of a company. Now, I want you to catch something here. Please don't confuse operating cycle with accounting cycle that we talk about in chapter 4. Two different things. Accounting cycle, remember, this with the process of preparing financial statement, or the step-by-step process for preparing financial statements. Now, moving along, here is a diagram that talks about the operating cycle of a merchandiser. So this is basically what I just explained to you. Now, let's take a look at additional interesting piece relative to a merchandise company. All right, here is a typical, of course you're already familiar with income statement. We said income statement is a financial report that reports the performance or the operating result of a company. So you have revenues, expenses, the difference is net income or net loss. So why are we talking about income statement again, since we already talked about it extensively in chapters 1 through 4? Because The income statement of a merchandise company has some peculiar issues. So let's take a look at some of them. Here we go. We say sales revenue. In chapters 1 through 4, we call it service revenue, because a service type of company like law firm or accounting firm does not sell. A merchandise company sells. So we have the revenue account title as sales revenue rather than service revenue. Another important thing that you need to know is cost of goods sold. You need to catch this. This is very confusing. Maybe, I'm not quite, if you listen to what it says, the cost of goods sold, what does that mean? That is the cost of the good that you sold. Let me give you an example. If you go to Italy, in Europe, and you buy a dress for $60, you come back to the United States and sell the same dress for $100. So your selling price is $100, but the dress cost you $60. So the cost of that dress or the cost of goods sold is $60. So that is basically what it means. Cost of goods sold, the cost of what you sold. Now let's take a look at another term here, gross profit. The difference between net sales revenue minus cost of goods sold, we have the fancy name for it called the gross profit. Now every other thing else is operating expenses. Cost of goods sold obviously is an expense. So cost of goods sold is not only an expense, it is the largest or usually the biggest expense on the income statement of a merchandise company. Moving along, here is a comparison between the income statement of a merchandising company and a service type of company. Why are we doing the comparison here? Because there are some peculiar issues here or unique issues here in the income statement of a merchandise company that are not applicable to income statements. So here are they. Cost of goods sold, the cost of what we sold. Why is that not applicable to a service company? Because service companies do not sell stuff. They just provide services from their head. So now the difference between sales revenue and cost of goods sold, like we said, is gross profit. That is not applicable to a service type of company. So those are essentially the peculiar or unique issues on the income statement of a merchandise company versus a service company. Now let's take a look at balance sheet. One peculiar issue stands out here. Look at this. In a balance sheet of a merchandise company, we have merchandise inventory as an asset. So at the end of the year, all this product in Walmart, their inventory is part of their asset. Usually merchandise inventory is one of the largest assets of a merchandise company. Now look at the balance sheet of a service type of company. There is no inventory. Why? Because a service company does not buy stuff to sell. So at the end of the year, they will not have inventory. So that is one peculiar difference. Moving along, let's take a look at what we have here. This is a big deal. Every merchandise company has to deal with inventory. Two important issues that you need to get hold of. At the end of the year, the question is, what is the value of the inventory that you have on hand? How much did you pay for the inventory that you have on hand? And how much did you pay for the inventory that you sold? Those two important issues have to be dealt with in a merchandise operation. Why? Listen to this very carefully. This is important. Because at the end of the year or at the end of the accounting period, when you prepare your financial statement, number one, income statement, you have sales revenue, you have cost of goods sold. Remember, we said the difference between sales revenue, let's say $1,000, and cost of goods sold of $800, the difference is $200, and that is what? Gross profit, okay? So the question is, how do we determine cost of goods sold? Another question, so we need to, why do we need to determine cost of goods sold? Because we need to prepare the income statement, and cost of goods sold is one of the items on the income statement of a merchandise company. Look at, on the balance sheet, remember we just talked about assets? One of the assets of a merchandise company is inventory. So for the inventory that we did not sell at the end of the year, what is the value? How much did we pay for it? So these two important things, ending inventory and cost of what we sold, we have to deal with them. We have to be able to figure them out at the end of the accounting period or at the end of the year in order to prepare our financial statements. That being said, how do we do that? We do that by using one of two systems. Number one, we call this perpetual inventory system, or we use periodic inventory system. Now, I think, let's quickly go ahead and wrap this up, and this will be the end of part one. Let's take a look at periodic inventory system. Periodic inventory system.
You just start. You just ended part one and kept going.
So we are still on part one. As a matter of fact, sorry about that. I think we need to wrap up chapter one at this point, and we'll continue part two presentation of chapter 5.